Today I'm going to be describing the development of accounting before 1929. So in the 3rd century BC, Mesopotamian actually had tokens that they used as a form of currency, and there was also some receipts found that had objects' names. Then in the Renaissance is when accounting really started, in which in 1340 the earliest known double entry bookkeeping was found, and they also closed the books at the end of the year and prepared income statements. Then in the 16 and 1700s, there was an increase in outside stakeholders, and this gave rise to a profit and loss statement and the statement of balances, which provided information about the capital of the company. Then in the 1800s, outside investors became even more important, in which profit was considered to be an increase in assets from any source, and the costs and income concepts had not been developed, but the concepts of capital maintenance and income became very important. The Industrial Revolution also required new forms of accounting, such as managerial accounting. Then, during World War II, there was a perception that businesses helped win the war, so business reform regulation became less of a priority, and accountants' roles moved from protector of third parties to more protectors of businesses. Then in the 1920s, financial statements were viewed as a representation of management, and GAAP was not required during this time. Also, during this time, accounting was largely unregulated. The accounting practices and procedures used by firms were considered to be confidential, which gave rise to firms knowing little about the other companies and resulted in a lack of uniformity in the accounting practices among the companies. Bankers and creditors were the only ones who were really using the financial reports during this time, and this caused them to have kind of control over what was going into them, which was mostly disclosure of cash and near cash resources that they could use for repayment of debt. And the American public typically did not invest in corporate sectors until about the 1920s. This is when the federal government made lump sums for the retirement of Liberty bonds, and the public suddenly had large amounts of cash, so private corporations and the government encouraged people to invest in American businesses. And the people's capitalism concept took hold, and the number of individual shareholders rapidly increased. Unfortunately, the financial statements lagged behind investors' needs, so the reports continued to be prepared for primarily creditors. And it wasn't until the 1929 stock market crash that shareholder investors began to question whether accounting and reporting practices were adequate for these individual investors. So the realization that financial reporting was based on widely varying accounting practices and were frequently misleading to current and prospective investors led to a period of the developing of accounting standards after 1929.